Okay, so next up is another one of our curate managers. So this is value now. That was quality, this is value. So it's Lyrical Asset Management, which is a New York-based boutique that was founded in 2008, which probably might not have been the best of time to start a value boutique, and given what the market was doing. We have a very unique style of value. So it's the cheapest quintile stocks, but companies with earnings growth that is growing stronger than the market. Now, at first I thought, how do you find those type of stocks? They don't exist. But that's the corner of the market that Lyrical focus on. And one interesting story is I joined Momentum from a company called Seneca when Momentum bought us. And we did our own US manager search for a value manager, and we came out with Lyrical. We were quite proud of ourselves. We got strong returns from the investment. And that was the US equity strategy. When Momentum bought us, the Momentum team had done the same analysis and come out with Lyrical as their US value manager as well. So two separate teams at the time, weren't communicating, both following their research process, and both came out with the same manager. So clearly we hope that Lyrical are doing something right. So I'll hand you over to David now for the presentation.
Thank you. Thanks, Gary. Thanks, everyone, for showing up and being here. I assume I'm after lunch, right? So everyone is, how are you? Good to see you. Good. So anyone here has heard of Lyrical? Oh, wow. Good. Excellent. Oh, good. I hope a good eye. Good. So we are, as Gary correctly described, a value investment boutique. And what I'm about to tell you is very brief. I'm only going to have about 10 slides up there, and 2 of the slides are identical. So pay attention, and you'll get extra points if you see what the identical slide is. But you feel free to ask questions at the end. I'll focus a little bit about what we do and go into a few examples so you can see it. So let's see here. We are a firm founded by Andrew Wellington and Jeff Keswin in 2008. We manage $7.7 billion. It's mostly in our US value product, but I'll focus today on our global value product, which is an extension of it with the exact same process. And that's also the product that will be on the Curate, or already is on the Curate single manager platform. We're characterized by a very high active share. We have 50 stocks chosen from the 2,500 largest stocks in the developed markets, and we have a very low turnover. We turn over about 15% of our stocks annually. Okay, these are not the more important slides. I'll run through them quickly. This is the PM team: Andrew Wellington and John Mullins and Dan Kaskowitz. John Mullins will join me, for those of you who are from South Africa, will join me in early November at the Curate launch event. We can go into exactly who they are. Why would you want to be a value investor, and why is it relevant for the fourth industrial revolution? So being a value investor is very, very profitable. There's this narrative out there that value is dead. And that is actually true if you look at the value index. The only problem is that the value index doesn't represent value stocks. That's all very confusing, because how do they have the right to put the name value in their value index name? And they all do it, by the way. S&P 500 value, Russell 1000 value, MSCI value. And none of them are value indices. They're constructed in a way that makes them actually broad indices. So I'm going to spend a little bit of time on that in the beginning. That's critical to understanding what value investing is. So we believe, I think the common understanding of value investing is that it is buying the cheapest stocks in the market, right? That's the basics. Buy the cheapest stocks in the market. Now, the value indices, if you just buy the cheapest stocks in the market, you get this dark blue line since 1974. The reason we use 1974 in this chart is that's when the indices were developed, specifically here the MSCI. So you would outperform by 572 basis points. That's almost 6% per annum, just buying the cheapest 20% of stocks. So how come it is that the MSCI World and the MSCI World Value have such a bad performance compared to the cheapest stocks? And why can the MSCI World Value call itself a value index? So the way that they're constructed, these indexes, is the way that all of them do it is they have to put roughly 50% of the market cap in each growth and value. So again, the dark blue line is 2,500, the cheapest 20% of the 2,500 stocks. The MSCI World consists of 1,400 stocks. And now they have to balance the market cap 50-50. That's part of how they do it, right? But the problem is that a lot of the growth companies have very high market cap, right? NVIDIA, etc., right? So if they have very high market cap, you need to have a lot more stocks in the value index in order to make up for that higher value cap, so you can keep an equal balance, right? So it ends up being that the MSCI World Value Index, out of the 1,400 stocks in the MSCI World, has almost 1,000 stocks. Now, that's very different than just investing in the very cheapest stocks, right? That's almost 70% of the market. So the MSCI World Value, and this goes for S&P 500 value, it's even worse there because they were talking about US stocks. There's about 85% of the S&P 500 value is in the value index, right? S&P 500, 440 stocks are in the value index. So this very big skew, and that makes the value index a very bad index because it basically is it's the stocks that don't grow. And that's, you don't want that, right? So it takes out all the good growers. So for those who say that value is dead, they're 100% right if they're looking at the value index. The problem is the value index is marketing itself as something it's not, which is value. And if you just invest in value stocks, you will have a very superior performance to the MSCI World Index. Okay, that is why we're value investors, and that's why it's still relevant even in the fourth industrial revolution. What do we do, or how do we do it? We believe that the secret to doing this right is to actually combine value and growth. And value is going to be the driver of returns. We just saw that on the previous slide. Just buying the cheapest stocks, you will outperform the market over time by about 572 basis points, right, on average over the last 50 years. But it's also important to consider other aspects in order to improve your chances for investing. So we have 3 criteria for investing: value, quality, and analyzability. Value is the most important. We work with a proprietary screen to screen the market for the cheapest companies based on 5-year forward normalized earnings. Happy to go into it in detail on the side or Q&A afterwards. And then after we've done that, and we end up with around 20% of the cheapest stocks in that index, in the global fund, it's 2,500 stocks we look at. So we end up with 500 stocks that look statistically cheap in terms of earnings. We look among those cheap stocks to find the ones that are good quality. Good quality we define as return on invested capital of more than 10%. So that excludes businesses such as airlines or utilities that have very high fixed costs, so therefore very low return on invested capital. So we exclude those indices because we've experienced that they're harder to get right. You know, they have the high fixed costs, very difficult business to get right. And then on our analyzability criteria, we exclude businesses that are hard to analyze, such as banks or big conglomerates or pharmaceuticals or biotech or high tech, where it's very difficult to get the 5-year forward normalized earnings number right because they're such complex businesses and they don't even have full transparency as to their business, right? The CEO of Citibank, he doesn't know what the foreign exchange trading group is going to make in 4 years from now. No clue. It's all over the place. We could buy a business that's, let's say, a private banking business where you have recurring revenues and just based on the assets under management. That's an analyzable business, but not a big bank that trades and has a loan portfolio that's not transparent and things like that. So we skip a lot of businesses, and that is our approach. Here comes the important slide. If there's any slide that you should remember and not fall asleep while I'm speaking, is this slide here. This is the result of our analysis, right? So on the left side of the chart, you have what other value managers will be able to give you. A cheap portfolio. What you see here is the dark blue column is the PE of our portfolio. The lighter blue is the PE of the World Value Index. And I don't know what you call that color. Also blue is the MSCI World PE. And as you can see, we have an extremely cheap portfolio. In this market with the MSCI World at over 18 times, almost 19 times, we're trading at 10.5 times next 12 months earnings. That's a cheap portfolio. Now, you may say you have crap companies. That's why you're able to buy them that cheap, right? And it could be. However, because of our quality and analyzability criteria, you get the right side of the screen, which is the earnings per share growth of our portfolio versus the S&P, in this case, MSCI World and MSCI World Value. And as you can see, we have an almost 9% earnings per share growth, with the overall MSCI World being at 5.4%, and we're more than double that of the World Value at 4.1%. So this is kind of critical. This is the unusual thing that we deliver in this combination between value and growth is we deliver a portfolio to you that is growing faster than the market at half the price of the market. That's what we're bringing to the table, and that's why this is the most important slide for you to remember in terms of what it is that we do. So this combination of value and growth. No one really out there, no one else really does it. There are other people who are just doing straight value, and that's great, and they'll have good returns and outperform the market over time. We saw that on the first slide. But no one else is really combining this value and quality. It's difficult for quality managers to do it because they're not really, don't have the value approach. And it's difficult for value managers to do it because they just like to find cheap stocks and they don't care that much about the quality. We do have this unique combination. It has a little bit to do with the DNA of the firm. Happy to go into details why that is, but this is the background for what we do. Now, if we take a look at the cheapest quintile PE over time, and here I've taken it back for 20 years, and we look at the PE of the market, that will teach us a little bit about what the opportunity is today. So this, again, the PE of the cheapest stock is the blue line here. That's the cheapest quintile, 20% of stocks. The dark blue line is the universal median. So the PE of the median stock, the median PE in the market, okay? Now that's the difference between the two will tell us a little bit about the opportunity, right? If the cheapest stocks are very cheap compared to the market, there's an opportunity to buy the cheapest stock because that likely will narrow because it's mispriced in a sense, right? So if we look back over the last 20 years and we subtract the value line from the market line, you get this shaded area below. And that's really fascinating because here you can see value cycles actually playing out, right? We had in 2003, we were just coming out. There was another peak here before. I'm not showing it here, but the tech bubble, when the tech bubble burst, we came into sort of say a value, you can call them value valley, right? During these valleys, value outperforms because the PE of the cheapest stocks sort of approach the PE of the market. The market PE comes down, value PE goes up. Then and during the financial crisis, it blows out again. The cheap stocks become cheaper, and there's a blow up in terms of the spread. So value underperforms here during this cycle, right? And then value outperforms again all the way until early 18, where value started to underperform. And it underperformed till about April of 2020. And these are called value cycles. So as you can see here, we're right in the beginning of a value upcycle, where that peak is sort of coming down from these very high levels, or this spread peak between the PE of the market and the value stocks coming down from this very high level. That is the opportunity that we are presented with today. That's why it's probably one of the best opportunities in our lifetime, certainly in the last 20 years, to invest in value stocks, in our opinion. Now, within the value space, we actually happen to find, and this is what's related to the fourth industrial revolution, we actually happen to find stocks that are AI related. They're just not the ones that are screaming out that they're AI related, like NVIDIA, for example. But we do find stocks that are related to AI in here, and I can give you some of the examples. For example, NRG. NRG is an unregulated utility in Texas, and they both own power plants, and they also market to retail, power, electricity. And we believe that they will do extremely well as the AI data centers are built out in Texas, and they will benefit from the higher cost of higher prices of electricity in that area. They're vertically integrated, so they own both the power plant and they also do the retail marketing of their electricity. And they can also buy electricity from some of the alternative resources and sell to their clients. So Energy is sort of a company that's a perfect value opportunity, trading at 10 times earnings. It's actually at 11 times earnings today. We bought it in 2020 at 7.5 times earnings. And it didn't move for 3 years until a year ago. And it's doubled in price since a year ago. And it's today just at 11 times earnings. And it's growing faster than the market. And so here's a stock that's growing faster than the market, only at 11 times earnings. And it actually has embedded in it some benefits where it could benefit from the transition to AI and the growth of data centers. Another example in there is Samsung. Samsung, they are a memory chip supplier. They're obviously with the AI, it's going to require a lot of memory through the supply chain, and they are the leader. They have 40% of the DRAM and solid state drive market. So Samsung is obviously also going to benefit from that roll out into faster chips and processing. And then another example is, well, as I said, WCC, it stands for Wesco. Wesco is an electrical product distributor, so that kind of brings together the NRG that is building out data centers together with Samsung that's supplying chips. What they do is they spend $22 billion a year on various stuff within the electrical space, call it like that. And they have 150,000 customers that they sell that to, making a 20% ROIC on that business. And they're also trading fairly cheap at Wesco. And we believe they've been overlooked, mainly because they have a little bit of buildup of inventory, but also just because of bad communications. And so there's also a lot of opportunity there. That's some of the examples that you see here. What I'd like to do also is just give you a few examples of things that we have held, that we still hold, some that we've sold that have benefited from AI. And these things were sort of embedded inside the company. No one else saw it. A few other people saw it, and we benefited. One that we sold earlier this year is Broadcom. It has the ticker AVGO, Avago. It has to do with a merger. They merged with Avago. Broadcom is a business that we bought in 2013, so we held it for 10 years. Right? When we bought it in 2013, it was trading at a 13 PE. Right? Now, this chart, just to familiarize you a little bit with the charts that we look at. On the top, you have the price of the company. In the middle, you have the EPS, the earnings per share growth of the company. And just for comparison, the S&P 500, because this is listed in the US, S&P 500 trades at, has an EPS growth of about 5%. So this stock is growing at 31%. It's growing 6 times the speed of the market. And we were able to buy it in 2013 at 13 times earnings. Broadcom, until 2022, was trading at 14 times earnings, growing at 30% EPS growth, just roughly at the same multiple that it traded at 10 years ago. It kept buying businesses, integrating them. It did extremely well. And then finally, in May of last year, someone realized that 3% of their chip production is within AI, and the price took off. And earlier this year, we sold the company at almost 25 times earnings. It's today trading even higher. We don't believe that it can continue to grow at 30%. We think growth is more going to be in the line of 16%. This is probably where the growth investors come in and look at this business. But this is a business that we recently sold. Here's another business. This is Ameriprise. I mentioned that we don't buy banks. Ameriprise, in a sense, is the only independently listed private bank in the U.S. All other private banks in the U.S. are within the big firms like Morgan Stanley and Goldman Sachs. Ameriprise is sort of moms and pops private banking in the U.S., and it's listed with its own ticker, AMP. So Ameriprise we still hold. It's one of the businesses that we've held since the inception of the fund, almost, I believe, since the inception of the fund. And as you can see here, again, we have price on the top, earnings per share growth in the middle, and price divided by earnings, PE, here on the bottom. As you can see here, the CAGR, the growth, EPS growth for Ameriprise, great business, growing at 2.5 times the market, at 13 times, right, 13%. And we bought the stock at around 10 times back in the early days. But the stock is still trading at around 12 times, even though it has this phenomenal growth rate. It's starting to get a fair value, but it's not there yet. We still hold the stock. Here we have AerCap. AerCap is an aircraft leasing company. Because it falls within the financial sector, I put here on book value per share instead of earnings per share, just because it's a financial, it's better to look at it as a book value. And you have also here price, and you have price to book here on the bottom. Again, AerCap is a great business. We would never own an airline, but we really want to own the aircraft lessors. It's AerCap and Air Lease. For example, we own both of them. Because if an airline goes bankrupt, the first one to claim anything is AerCap and Air Lease. They take the airplane and move it to someone else and rent it out. It's a great business. And they're still cheap, this business. It's still an incredibly cheap business. Compared to, in terms of this is book value compared to S&P. Finally, the most important chart, and I said I would show it 2 times. So when you wrap all this up, what we do at Lyrical is we try to find cheap, good, and simple businesses, and the result is this. They trade at 10 times earnings when the market's at 18, and they grow at almost 9% in terms of earnings per share when the market is at 4 to 5. And that's what we do. It's that simple. I think I probably didn't go over my time, but if anyone has any questions.
Thanks, David. Enjoyed the presentation. You said some of those stocks you've held since the inception of the fund. I'm interested to know what you do as you attract new money to the fund. Do you continue to buy those stocks and therefore dilute the growth of those as they're growing, as they get higher, or do you dilute the position in the fund by buying other stocks?
We do not rebalance when we buy a stock. So that's our approach. What that means is that when we get new money, there's, let's say, 50 stocks in the global portfolio. You give us 50 million tomorrow, we will buy, according to the weighting of the model portfolio. It's not totally equal weight. It's cap scaled, we call it. I can explain it exactly how it's done. It's roughly equal weight portfolio. We will buy, call it roughly 1 million of each. For slightly smaller market caps, we buy less. But we have a model portfolio. The portfolio management team is not even involved. They don't even know 50 million came in. The operations just buy the stocks according to the model portfolio, and we don't rebalance, we don't trim, we don't add. We've actually found that takes away from the performance, trimming and adding. We've done a lot of research. Happy to share that, to go into details, but it actually, interesting enough, it doesn't add value to trade around your positions.
You mentioned that you've got a unique DNA. Can you summarize that in a paragraph?
Yes. So in a paragraph, the value investing world is a very small world, right? Sort of starts with Benjamin Graham in the 1930s, call it. He had some students, right? Warren Buffett was a famous one, and Warren Buffett has done more for value investing than anyone in the, he's sort of the polar opposite of the value index, which has done more worse for the value investing than anyone else. But one of those students of value investing was Sanford Bernstein. Something you may remember, became Alliance Bernstein. Anyway, Sanford Bernstein had a chief of research called Rich Pezina, P-Z-E-N-A, who was there in the 80s, and he was working with a guy called Ron Gottfleisch. So they called them like, they're sort of grandkids of Benjamin Graham, if we should do the family tree. And Ron Gottfleisch went on to manage the value group at Goldman Sachs. Rich Pezina started his own firm with money from a gentleman called Joel Greenblatt. Joel Greenblatt wrote the little book that beats the market. It's a little 70-page book. If you haven't read it, you should read it. Joel Greenblatt was all about combining value with quality. He has his own funds today where he tries to optimize each. So it's different than our approach. And he includes like hundreds of stocks. But Joel Greenblatt is very well known for sort of putting that quality criteria around value. The first analyst they hired when Rich Pezina started his company in 1995 with $1 million from Joel Greenblatt was Andrew Wellington, the PM of our firm. Ron Gottfleisch left Goldman Sachs in the end of the 90s in order to start a long-short version of Rich Pezina, inside Rich Pezina, in I think 99 or 2000. And John Mullins and Dan Kaskowitz worked for Ron. That firm was called Elm Ridge. It spun out later, Pezina. So in a sense, Andrew Wellington was the grandson, if you want, and so is John Mullins and Dan Kaskowitz, and those are the three portfolio managers of Lyrical. John and Dan came to us 7-8 years ago because Andrew Wellington had done an interview in a magazine put out by Columbia Business School, a value investing program. And they had been bothering Ron Gottfleisch for many years about focusing on quality and not just value, because it's sort of I don't know if any of you have been an analyst, but if you're an analyst and your PM boss tells you, okay, go analyze, I don't know, Citibank, and you're sitting there and you're looking at Citibank, it's just as cheap as Ameriprise, but for Citibank you get sweaty palms. It's really, you say like, this is never going to end well, no matter what. I'm never going to get this. Whatever I say, I won't get it right. But Ameriprise, you can get right because it's easier to analyze. So they realized that in their process as analysts under Ron Gottfleisch. Ron is type of personality, he would scream a lot, and I guess. John reached out to Andrew after that interview, and in the process joined Lyrical and brought with him Dan Kaskowitz. So that's how the PM team kind of came together. But Andrew Wellington, is the founder of the firm and the CIO.
Quite a long time ago, there was a Lyrical presentation at a think tank, and I'm pretty sure at that time there was 33 stocks held
Oh,
in
yeah.
equal weight.
That's 100%
What,
right.
what changed or
Nothing's
evolved?
changed. You're speaking about the U.S. value product. So our three products, again, the U.S. value product has 33 stocks. Actually, at the moment, it has 32 stocks. That changed. We have one less at the moment, but we're looking for another one. We're a little bit OCD because we like to have 33 equal weighted stock with 3% each and 1% cash. So that's probably what you're referring to. That's the U.S. product. The reason that, so for the U.S. product today, and Momentum's invested also in the U.S. value product, we have two versions of that product, either equal weighted, which we believe is the right way to do things, equal weighted. However, that limits our capacity in the product a little bit because there's the smaller stocks. That as we grow, we become close to 10% of those businesses. So that's why we invented the cap scaling, so that we wouldn't ruin the capacity of that product. And when we started the global value product, we said, okay, we'll just do cap scaling instead of equal weighting, even though ideologically, probably we believe equal weighting is the right way to go. But it's just modified. It's slightly modified equal weighting. For the global value product, there's 50 to 55 stocks. I believe we're closer to 50 at the moment. So it's in a sense the 32 US, not 33, 32 US stocks, and then 27, 28 non-US stocks in it. The balance, if you look at the MSCI World, I believe due to NVIDIA and all these things, I believe the US has a 70% value of the MSCI World today, but we are slightly less skewed there, so we have about 55% allocation to US within those 60 stocks.
I want to echo Gary's comments at the start. How is it possible that exists stocks like yours, cheap and also growing fast, and how is that not arbitraged away?
We ask ourselves that question every single day, right? That's the key. How is this even possible? So there are several reasons for it. Sometimes stocks fall between the chairs, like they may belong. For example, Ameriprise, right? Ameriprise is a private bank in a sense, right? But it's the only type of its kind that's not within a big bank that's separately listed. Other times it's, we've held in the past stocks like, for example, I'm trying to think of good examples. Many of our stocks are really the only one of their kind or one of few of their kind, and they're sometimes not fully understood. They don't fall within their industry exactly right, and that's mainly the reason. It's rare. It happens rarely, right? We don't do more in the U.S. portfolio where we have 32 stocks, 32 stocks. We do 4 to 5 trades per year, right? When we buy, we sell one and we buy one at the same time. So it happens rarely. A lot of our time is spent on screening. So it takes a long time to try and find these stocks. It's not that easy. So that's where a lot of the time is spent. And if you spend a lot of time on screening, then you can find them, but they are rare. They're definitely rare. We couldn't do in our U.S. fund. We couldn't do a product with 50 stocks. Like we have 33 stocks. Maybe we could do 37, 38, maybe 40, but not 50, right? So in our global product, we probably couldn't do a 70 stock portfolio. There's not enough stocks. So remember, there's 2,500 stocks that we look at in the global portfolio. So having just 50, it's a very small part of the universe. So it's very rare. The market is not always efficient, though. It is not. This is a proof. I mean, look at it. I'm saying Broadcom, but just look at some of the other stocks. Just Ameriprise, right? If you have an earnings per share growth of 2.5 times the market, you shouldn't be trading at half the price of the market. It doesn't make any sense, right? A dollar is a dollar is a dollar, right? Yeah, go ahead.
Could you not use AI to find out other stock that you're missing?
Well, in a sense, we're using, well, it's not, AI is a new term, right? But we have a proprietary model, and this may be a good time before Andres asks the question to just describe how we find these stocks. I noticed, but how we find these stocks. So this proprietary model that we work with, which is similar to what Pazina works with, similar to what Elmich worked with, it's similar to what sort of a lot of real value managers work with. The way it works is that we take earnings data for all of the, let's take the U.S. as an example. Well, all the 1,000 largest stocks in the U.S., for as far back as we can, we pull in earnings data, and then we take analyst estimates 2 years in the future from the street. So if analysts are estimating earnings, then we plot the line, right? So ... Then we draw a best fit statistical line through those dots. take it out to 5 years, so project it out to 5 years. We apply a terminal multiple to that 5-year forward normalized earnings number. Normalized just means we do it with math, obviously, right? But we kind of wing it, right? We draw the line through the dots, we get out to 5 years. Then we apply a terminal multiple to that number. We use the terminal multiple of 9. That's where the multiple of the median stock, the median stock in the US, the median multiple of the median stock has been most of the time. So that corresponds to a 16.5 multiple of today. So that's 9 times in the future. So it's a shortcut to a DCF. Then we bring that number back to today and we see if the stock price today has more than 35% upside to its fair value, we're interested. Okay? Now that just means interested. And we print out this screen. So imagine 75 little lines on a piece of paper times 12 pages, right? You get to 1,000. Is that right? Yeah, you get to 1,000. And we throw out the 10 bottom pages. We just look at the top 2 pages. And then we go over with a ruler and a little highlighter, and we look for stocks that are high quality and analyzable. The way that is in practice done is all of the investment team does this work independently or at the same time. So they go through the screen, they take the ruler, they look down the ruler, they highlight's the wrong word, they skip a lot, right? The first one may be, I don't know, Santander. It's a bank, waste of time, right? The second one may be, I don't know, Fitbit, GameStop. Totally unpredictable. What are the earnings going to be 5 years from now? No one has a clue. Is it going to exist? Maybe, maybe not. Right? So you skip all those, and then you highlight the ones where you're possibly interested. And there may be 7 or 8 highlights on those 2 pages, and everyone does that independently in the team. And then they meet and they decide which one to do an analysis on this week. And that's where the AI stops, because now you have to do actual bottom-up research. And we use all of the expert networks, and we use all of these resources that we have. And that process can take between a month and 6 months, right? And then they come up with a conclusion as to, indeed, this stock is really, truly cheap. Indeed, it is really, truly high quality. And indeed, it is really, truly analyzable. And then it goes on our bench, because we already have 33 or 32 companies in the portfolio that already are cheap, good, and analyzable. So why would this one be better? Which one should it push out? Maybe we have a stock here that only has 20% upside to fair value, but this one has 60% upside. But who knows? Maybe the 20% stock upside to fair value will go there tomorrow, and the 60% upside to fair value will take 10 years, like Broadcom, right? So then comes the art as to when do you make that switch? Do you do a superior substitution, or do you wait for this stock to go to fair value and then you substitute? So that is the process, and then we always have a fair upside to fair value number in the portfolio. We always know what that is. Every day, our models say, today the portfolio has 105% upside to fair value. But we don't always, most of the year, 361 days of the year, we don't do anything. I mean, we do work, but we don't. That was phrased wrong. 361 days out of the year, we do not interact with the market. Then on day 362, we call the broker. We say, "Hi, it's Lyrical. We'd like to do a trade." And they say, "Who the hell are you?" Right? And then finally, they let us do a trade. And then we do a substitution portfolio. That's how it works. And that's not totally true, because we get inflows. We have to act with the market. But that gives you a sense of how it works.
I just wanted to ask, the quality overlay, does that solve for the lumpiness that comes with value, or do you there's no escape?
It's great, really, really great question. So lumpiness in value, do you refer to the lumpiness of price moves, volatility of price, or volatility of earnings?
I think on a portfolio. So when you're speaking to clients and you wait 7 years and it's a drought and all of a sudden value skyrockets, and then so there's a journey to it.
So we managed to outperform our composite, certainly our caps composite. We managed to outperform the last 3 years by about 90 basis points, which is not what we're looking for, but that beats losing money while we're waiting to make a lot of money, right?
It's 18 years and a KGAR that we're measuring here, so there's a lot that happens in between.
We are long-term investors. That's part of our added value. The fact that most of the market actually is very short-term, that's part of our added value, because they can't see long-term. They're looking for the next quarter, and they all are looking for, well, there's nothing in the next quarter that's going to make this stock go up, therefore I'm not going to buy it. We see, well, here's a great business trading at a cheap price. It's analyzable. Buy it, right? The difference is that we have an undefined time frame Whereas most of the market today has a 1 day time frame, or maybe 3 months, at best 1 year. No one looks beyond 1 year. So the fact that we're playing in that very long term gives us a benefit. The volatility of our earnings are less than that of the market. The drawdown of earnings in recessions is much less than the market. I don't have a slide in this presentation. So our earnings volatility is much less than the market, but we cannot control what the price trades at any one time a day, right? Because the market may say, I hate cheap stocks, right? And it'll just sell all cheap stocks without looking at earnings. That gives us an opportunity to the question in the back as to buy those stocks cheaply, right? But it's, I would say our earnings volatility for sure is less than the market. Yeah, absolutely. And that's what we're aiming at by buying only quality and highly analyzable businesses. But the price volatility is not in our control. So, you decide to vote for Brexit in the UK and, markets fall and the price volatility rises. That has nothing to do with the company, nothing to do with our analysis. It's just for 1 week, So price volatility can sometimes be higher, and the cheap stocks sometimes can be a victim of that. Then you have to look at the earnings. We look for stable earnings. I mean, you look at it here. This is, I don't know what I have, Ameriprise. Look at this stability of earnings. Look at the, I don't know if I have a one up here that's really shows you these stocks have a much better earnings history than the market. That's what we look for. We look for that stability of earnings.
You got to invest and look for what's on the box. So no one's looking for you to a value manager for consistency. It's a long-term play and it's a part of a portfolio. You wouldn't put your entire portfolio in a value strategy.
I have my entire portfolio value
because you just see it.
And
you understand.
You shouldn't. Clients should not put all. Look, I'm not going to sugarcoat it, right? Like, value investing is buying cheap stocks that are, where the market doesn't recognize what they're worth. What we do is we try to take away some of that uncertainty and only buy cheap, high-quality, analyzable stocks, and that mitigates some of the price risk there are. I would always encourage you to look at the underlying earnings of these businesses. So look at earnings per share, look at the stability of earnings, and then price. I mean, if you look at this earnings per share, look at the price. It's much more volatile than the earnings.
Sure.
So you have to look through and look at the earnings per share.
Brilliant. Thank you.
Yeah.
Any questions? Okay. Thanks, David. That was over.